Here's something you'll hear constantly from people who've never invested. The stock market is just gambling. You're just guessing which way prices go. It's all luck. You could lose everything. It's rigged for the rich. And honestly, if you only knew what most people know about the stock market, that conclusion wouldn't be completely unreasonable. Because on the surface, prices going up and down, people winning and losing money, everyone trying to predict what happens next, yeah, it can look like a casino. But here's the thing. That surface level view is missing almost everything important about what the stock market actually is. And that misunderstanding, that casino framing, is one of the most expensive mental models a person can carry. Because it keeps people out. It keeps them on the sidelines while others build wealth. It keeps them in savings accounts that lose ground to inflation while the market compounds for everyone who showed up. So today we're going to fix this. What the stock market actually is. How it fundamentally differs from gambling. What smart long-term investors understand that casual observers miss. Let's start from the beginning. What is the stock market? At its most basic level, the stock market is a place where people buy and sell ownership stakes in companies. When a company goes public, it sells shares of ownership to investors. Each share represents a small ownership stake in that company. When you buy a share of Apple, you literally own a tiny piece of Apple. You're entitled to a proportional share of the company's assets and earnings. If Apple does well, your ownership stake becomes more valuable. If Apple pays dividends, you receive a portion of those profits. If Apple grows, so does what your ownership is worth. That's not gambling. That's ownership. Gambling is a zero-sum game. Someone wins exactly what someone else loses. The casino doesn't create value. It just transfers money from losers to winners minus the house's cut. The stock market is not zero-sum. When companies grow, when they generate more revenue, hire more employees, create more products, the value of the entire market grows. Everyone who owns a piece of that company benefits. Nobody has to lose for you to win. That's a fundamentally different structure than a casino. Over the last 100 years, the US stock market has created enormous amounts of net new wealth. Not transferred from losers to winners. Created from economic growth, from innovation, from productivity improvements, from companies solving problems people are willing to pay for. That wealth creation is what investors participate in when they own stocks. Now, why does the market go up and down? This is where it starts to look like a casino to outside observers. Stock prices fluctuate constantly based on expectations. Investors are constantly pricing in what they think companies will earn in the future. New information, earnings reports, economic data, geopolitical events, product announcements changes expectations and moves prices. In the short term, this process is messy, emotional, reactive, sometimes irrational. Prices can move dramatically on news that turns out to be irrelevant long term. They can crash on fear even when underlying business fundamentals are strong. They can spike on hype even when fundamentals are weak. In the short term, yes, markets can feel chaotic. But here's what changes the picture completely. Over the long term, stock prices follow earnings. As companies grow their revenue and profits, their stock prices follow. Not perfectly, not immediately, but consistently over time. The S&P 500 of the largest American companies has grown in value over the last century because those companies have collectively grown their earnings. That's not luck. That's the result of businesses creating real value in the real world. People buying more things. Technology improving productivity. New industries emerging. Global trade expanding. The stock market is just the financial representation of all that real-world activity. So where does it start to look like gambling? And what's the real difference? Trading individual stocks short-term, that is closer to gambling. If you're buying a stock today because you think it'll be higher next week, you're making a short-term prediction about price movement. That's speculative. That's closer to betting than investing. Most people who do this lose money. Not because markets are rigged. Because short-term price movements are genuinely difficult to predict, even for professionals with massive resources. Day trading. Option speculation. Trying to time the market. Chasing hot stocks. These approaches consistently produce poor outcomes for the average person. And this is where the casino comparison comes from, because this type of activity really does have gambling-like characteristics. But this is not how long-term, diversified investing works. Buying a diversified index fund that owns hundreds or thousands of companies, and holding it for decades, is not speculation. It's participating in the long-term growth of the economy. The difference between gambling and long-term investing comes down to one thing: expected value over time. In a casino, the house always has an edge. The longer you play, the more certainly you lose. In the stock market, Long-term diversified investors have historically had a strong positive expected value. The longer you stay invested, the more certainly you benefit from compounding growth. Opposite dynamics. Completely different games. Now, what about market crashes? People point to crashes as proof the market is dangerous. And yes, crashes are real and painful. 2008, the market dropped 50%. 2020, dropped nearly 35% in weeks. 2000, the Nasdaq dropped nearly 80%. These are serious declines. But here's the full picture. Every single one of those crashes was followed by a full recovery and eventual new all-time highs. Every one. The people who lost permanently in those crashes were the ones who sold at the bottom. Or the ones in individual companies that collapsed and never came back. The people in broad, diversified index funds who held on, they recovered everything and then some. The market going down is not the same as losing money permanently. It's only permanent if you sell. Think of it this way. If you owned a house and someone told you your house was temporarily worth 30% less, would you panic sell? Or would you understand that real estate values fluctuate and that your house still has the same rooms, same neighborhood, same long-term fundamentals? Most people would hold. The stock market deserves the same mental framework. Short-term price drops don't change the underlying value of the businesses you own. They just change what someone would pay for them today. And today's price is not what matters for a long-term investor. What matters is what your portfolio is worth in 20 years. So what does smart long-term investing look like? Own many companies, not just one. Use diversified index funds. Contribute consistently regardless of market conditions. Don't panic during downturns. Don't get greedy during run-ups. Keep fees low. Keep the time horizon long. That's it. No gambling. No speculation. No need to be smarter than the market. Just consistent participation in the long-term growth of the economy. The stock market isn't a casino. It's a wealth-building machine for patient people. And the cost of believing otherwise, of staying on the sidelines, is measured in decades of compounding that never happens. Hit like if this changed how you see the market. Subscribe for the full series. Share this with someone who thinks investing is just gambling. They need this perspective. Own the economy. Don't try to beat it. Just own it. See you in the next one.